an objective state of mind, and you're not going to allow your bias or your fears or your desires to have anything to do with your trading. You're going to look at the data for what it is. You're going to believe that 50-50, anything can happen at any given time. And when you do that, you're going to find yourself an objective point of mind, and you're going to be clear about the actions that you will or will not take when it comes to your trading. To be profitable, you need to be consistently thinking that the market can do whatever it wants to do, whenever it wants to do it, at any given time. To be consistently profitable, you must be thinking that the market can do whatever it wants, whenever it wants, and any time it wants. That's being objective. Now, many people get into trouble thinking that the market can't, won't, or do certain things at certain times. That's a problem. We will look at it and we will start getting our emotions involved. We'll start getting fearful about what the market will or will not do, and that will hinder our progress of taking profit. So when we get in a place where we're going to be objective, then we have to be sure that we stick with the premise that the market can do with whatever it wants, whenever it wants, anytime it wants. When you be objective, you actually release yourself from distorting the market information. When you are in an objective state of mind, you release yourself from distorting the market's information. The warning is this: when you distort the market information, you're obviously not acting in your own best interest, because you're trying to impose your will on the market that can do anything, whenever it wants to, however it wants to, at any time it wants to. Now, let's take an example, and let's look at it this way here. Let's say you're looking at one of your indicators that you have on your chart to help you discern what the market is actually doing. And this indicator, you really like the indicator, works really well for you, and it helps you find profitable trades certain times the market happens. But we know all indicators are based on information that's lagging, meaning that it's looking at historical data and crunching numbers and giving you outputs or drawings on your chart to say, these are areas of support and resistance. These are level breaks of daily, weekly, monthly, minute, 5-minute, 10, 20-minute charts. And these areas impose opposition, that means resistance to you, or support, where supporting the direction that you may be looking to move in. Now, the market is telling you that there's a short position that's brewing or has brewed, and you take the trade. Now, you take the trade to go short, and for some reason, the market stops moving. It starts to stagnate, starts to go sideways. Now, your indicator indicated that this market is moving in that direction, but when you get in the trade is not doing what you think it should be doing as fast as you want to do it, or not moving in the direction that you want, is pulling back, or whatever that may be. But your indicator said that this market is moving short, so now you're in the position. Now you're looking for the market to start moving down as soon as you get in the trade. Now myself, I call myself a breakout trader. What does that mean? That means that when I take the trade, I want that thing to break out, either drop like a rock or go in the desired position I want, and not waiting for a long time, but get in there as soon as I want to get there. Now, it's supposed to be going down, but the market is not going down. That's a problem. Now you start second guessing your edge, you start second guessing your indicator, and you make some assumptions, or you make some decisions to get in or get out of the trade, which is a good thing. Okay. Now, your tools on your chart is to help you make decisions. But if your tools are there and they're giving you the indication that the market is trending down, and you trust this tool, it works for you most of the time, then if you objective, you're going to be able to sit in that trade and wait till the top market move. You're not going to get jittery with your stops. You're not going to put yourself in and out of the trades 5 to 6 times. You're going to let the trade work itself out. Now, if the market starts to move a little higher while you're in this short position, then you're going to probably say to yourself, the market's going higher. It's just trades fixing to fail, but your indicator is saying, hold down, wait on it. It's going to come. It's going to come. And how many times we've been in trades and we get the trade and the market stagnates for a while, then all of a sudden something happens in the market, whoop, it drops in the direction that you wanted to go. And how many times that we did it and we actually got out the trade and then the market moves in the direction that the indicator told you was going to move. What happened there? You wasn't remaining objective, meaning that you allowed your fears, you allowed your desire for the market to move when you wanted to move, and you try to impose your will on the market. But you said that you're objective. You said anything can happen whenever, wherever, at any time. That's the market. The market's going to do what the market's going to do. Now, the indicator can be giving you false signals at times, so that's why it's a good idea to use multiple signals. But what I want to say to you is this here. If you remain objective, then you will look at the data for what it is. Now, let's just say this indicator says the market is going short, but the market starts moving higher. Objectively looking at the market, you're going to make some assumptions and you're going to make some decisions. Hopefully, you will make the right decision. My case in point, if I'm looking at the market objectively, I get in a trade right away, the trade starts to move in the wrong direction. Objectively speaking, I see the market is not doing what I think it should be doing when it should have done it. Myself, I cut the trade. I remain objective. I'm protecting my bottom line. But if I get in a trade and the trade moves in the direction I'm looking, let's say short, and start going south of my entry, going down, which is a good thing, but then it hits an area and it pulls back. Now, doesn't mean the trade is over. I mean, because I'm objective, because I understand the market is going to do what it wants to do, a pullback doesn't make me nervous because my indicator that I trust that works for me 80, 90% of the time is right. So I have to trust the indicator or trust my assumptions when I took the trade and allow the pullback to happen. And I don't stop myself out here because I know it's a wind up to pull liquidity to make the stronger move to the downside where I'm looking to go. If I am not objective, then when that pullback happens, I'm going to immediately get fearful, get scared, and cut the trade. And the trade pulls back like it does 80, 90% of the time, and then shoot to the downside, and I miss the move. Or I start chasing the candle once it starts moving. So when you're being objective, these things here, I think that's very important for you to look at. One, when you're being objective, you're constantly thinking that the market can do whatever the market wants, whenever it wants to do it at any time. When you're not being objective, you distort the information. You look at the market, it's going down, and you hoping it goes up, and you're trying to take a long trade. That happened to me this morning. I'm trying to go long, and the market not ready to go long. It was going short. I'm like, man, I lost 4 trades in a row. No, not in a row. Well, 4 trades overall, wasn't in a row. But I lost 4 trades. And I don't lose 4 trades, guys. I just don't. But I did this morning. Why? Because I was distorting the market information. My bias was long, and I should have been looking at the market more objectively and say the market is not ready, and I shouldn't have been trading. That was the answer to it. It wasn't that I was wrong. It's just that the market wasn't ready to move. So objectively speaking, I would have slowed my roll, and I would have stopped trading and waited till the market got ready to move in either direction, up or down, 50-50, and I would have taken the trade from there. So when you're not being objective, you start the information. I did it this morning. Okay. You're not obviously acting in your own best interest, because if you're trying to short the market and the market is in an uptrend, I think you're not looking at the market for what it's doing. Pullbacks are not reversals. Pullbacks are just that. How do I detect reversals? when it pulls back at least 50% of the move that it currently made to get to the level that it's at. Let's say they went long 100 points, and then I won't see a reversal until it gets below 50 points of that move. And then at 49, I say, now we got a reversal taking place. That's a change of character. That's a shift, not in structure yet, but a change of character, because the trend from bullish to bearish, and I have to accept that information. But a person that is not objective will take a pullback and say, oh, I'm going short because the market's short now. And then you would preemptively get in a trade that's going short for a moment in time, put liquidity that's going to eventually go back up, and you end up taking a whole lot of small losses. Now, using your indicators help you discern what the market probably will do based on historical data, but you have to remain objective because you're a decision maker. You're the one that can look at the market for what it's doing now versus the indicator saying what it's done over the past 5 minutes, 10 minutes, 30 minutes, an hour, or 1 minute, whatever candlestick the pattern that you're following. And my benefit to remain objective is really considering the price action versus everything else over anything else. Is the time, the price action level that is trading at, and it helps me remain with an objective perspective on the market. So even if your indicators will tell you one thing and your perspective on the market and price action objectively looking at it tell you something else, then I would use the price action over the indicator to make a decision whether I want to take trade or not. That helps me remain objective. What is the market doing right now when I get ready to take the trade? If you run in a situation where you have a conflicting signals coming in, then being objective means that I'm going to wait until the things line up. That's called diversions, meaning that one signal is telling you that the market is going long, another signal is telling you the market is going short, another signal is telling you the market is shopping around, where they're not cooperating with each other, and that's called diversions in market. And therefore, you should, as a trader, because you're objective, say things are not quite lining up for my favor. I'm going to slow down. I'm going to wait for something to line up before I take the trade. Never trade when you're having conflicting signals, meaning that there's no one in direct control of the market. The bulls are not in control. The bears are not in control. We're kind of like in this tug of war, and we call that range trading, or chopping in the range, up and down, going sideways. These are the things that we say about the market. Now, never trade the market hoping and praying that the market would do something that you wanted to do. Look at the market for what it's doing and make your decisions based on the solid information that's in front of you. One thing as a trader, I will definitely say to you is I would like you to understand that you do not have to trade every signal that you get on your chart, being objective. You only want to trade your A+ setups, being objective. So I am going to wait until everything lines up to give me the most favorable trades that I can take, and then that's the trades I'm going to execute. Whether it means I'm going to trade 1 trade today or 5 trades today. But being objective meaning that I'm going to have restraint. I'm going to have control. I'm going to be focused on what's in front of me, not what happened to me yesterday when I was trading, or the last 5 trades I've taken. I have to be objective to the trades today. Perfect example. This morning, I got kind of chopped up there, ended up with losing and being red this morning. But then a trade came about that met everything lined up. The signals was good. The levels were good. The confluence was good, meaning that my indicators were saying the same thing at the same time. I ended up taking 52 points out the market. Went from red to green. But the thing that kept me waiting until things lined up was I had the discipline to understand that my losses don't mean I got to hurry up and get the losses back. The loss was there. It's nothing I could do about the past. But because I was objective, I knew that the market was going to, at one time or sometime during the day, line up to give me a favorable outcome, a probability outcome of a favorable trade because of my discipline, because of me remaining objective and not just wanting to take any trade that shows up on my dashboard that gives me a signal. What is your best friend when you're being objective? It's confluence. TLP, time level price, confluence. your indicator, your MACD, your moving averages, your VWAP, your relative strength meters, and all these things that you use to make decisions with are all telling the same story at the same time. That's when being objective really blossoms, because you take them trades and the momentum will take you in a direction that you should go to secure the trade. Let's talk about, if you were in a trade, how would you view conflicting signals? I think I kind of covered a little bit now. One, what would be the objective thing to do? Conflicting signals, I kind of covered a little bit. Let's go ahead and run through it. If you were not in a trade and you want to put on the trade, would you get in the trade? Of course not. Why? I have conflicting signals. The objective thing to do is get out of the position and well, I guess if you took the trade here. Okay, and if you were in the trade, I quoted wrong. What would conflicting signals do for you? What would the objective thing to do? If you were not in a trade, you would put on would you put on a trade? Of course, that was a question. I'm sorry, I'm reading it wrong. I my print a little small for me, so apologize. The objective thing to do is to get out of the position and reevaluate. Let's just say, I mentioned that earlier, I take the trade, it immediately start going against me. Get out the trade. If I take the trade, it moves in the direction I want to go and it pulls back, I stay in the trade because the trade is just working itself out at that point. You should never get in a trade. As soon as you push the button, you're down 15 points. But that really is telling you that you're chasing candlesticks. If you're waiting for the trade to materialize, when you get in the trade, it should be moving with momentum in the direction that you want to go. One of the things I teach here at DT Coaching is how we get in the trade on pullbacks. What's a pullback? It's just a wind up for more strength and more power to make the next move up or down, whatever the direction that you're looking for the trade to move in. Now, if you're objective, you get out the trade and reevaluate. That would be acting in your own best interest, being objective. If you were in a trade, how would you view the conflicting signals? One, believe it or not, most will ignore the information and hope and pray that the trade will work out. I find myself there sometimes, but I don't hope and pray as much as I used to. But sometimes I will ignore the signals and take the trade anyway because I'm a price action trader. But it gives me a higher risk of loss because I didn't wait till my things, the confluence of my signals to line up. Always wait for your signals to line up. Now, is it okay to be wrong about which way the trade is going? Absolutely. I am wrong. I acknowledge I was wrong, and I would cease the trade. I will stop the trade. Okay. It's okay to keep my losers small and my winners large. To cut my losers quick and let my winners run. It's okay. Your whole job is to take money out of the market, not inject money into the market. So cut your losers quick and let your winners run. How do you do that? You have predetermined trade strategy built in, meaning that you will put on your trade with a stop in place, a protective stop in place. You will put on your trade with a take profit in place, and therefore you plan your trade and you're willing to take the risk, and therefore when the trade is not working out, you cut the trade. It does not have to hit your stop for you to cover your position or to get out of the trade. What does that mean? I kind of mentioned that earlier. If I take the trade and thinking it's fixed to move north of that means in the favor of my position, then if I push the button and it immediately starts to move back, I knew one thing. I took the signal and I got in the trade too soon, or I waited too long, I hesitated, and I'm in a pullback and I got to get out the trade right away because I want to minimize my loss. And I will wait for the trade to come back to that area and get back in the trade at that point, and that is okay. We call that a probing trade. Do your stop have to get hit? No. Admit that you're wrong, act in your best interest, and get out of the trade. It's okay to be wrong, okay? But it's not okay to be wrong about the market direction and ignore the signals. That is time to get out and start over. So I said it already. Don't ignore your signals. If the signal comes in, you get in and it goes against you right away, it's okay to get out and cover your position. But you want to make sure that you're acting in your best interest and your main objectives. Don't be tied to it where you start to move your stop in the wrong direction to give it more room. It needs no more room than you pre-planned for it to have. Okay. Now, if you have a lack of objectivity in your trade, it will kill your trading, guys. It would just tear things up. It will kill your trading. So remain objective at all time. Look for what the market is giving you right now and look at the information for what it is without lenses of distortion or fear that's sitting in. Don't ignore information like most people would do. It just don't work out for you. What you're looking for is the most successful times to get in the market. What's your strongest areas? Like VWAP is mine. I'm always taking VWAP trades because I'm 70% or better at VWAP. That means 30% of the time I will lose a trade, but it doesn't hinder my ability to be objective when it comes to taking a trade. When you're not objective, you will inject hesitation into your trades. Now, question here. What if you were in a trade? How would you view the conflicting signals? I think this is a repeat here. That's a repeat. Next one here. Okay. 7 characteristics of an objective person or an objective trader. Here they are. So you can recognize and achieve it. 1, you feel no pressure to do anything. That means that you don't have to take any trades. You can take the trade or leave the trade. Either way, you're going to be okay. The second thing, you have to have no feelings of fear. Because what you focus on the most, you become. What you focus on the most, become. If you're fearing loss, guess what you're going to produce? Loss. If you are fearing the market is going to work against you. I always approach the market with a positive point of view. I'm looking at the market not for what I can lose, but what I'm looking to gain. So I focus on the areas that will give me the highest probability of a successful trade. I don't focus on the things that once I get in a trade, or what I can lose. And what happens is you start moving your stops around and not giving the trade room to work out itself once it starts moving in your favor, and you end up fondling the trades or just bungling a good trade sometimes. And you may have had that happen where you take your trade, your strategy says 15 points, and you immediately move your stop to 5 because you only want to lose $100 versus $300 on NQ. That sabotages your success. So just make sure, guys, that you continue to operate objective and have a confidence in your edge. The third thing would be you feel no sense of rejection, meaning that the market is not against you. It don't know you from Adam. It's not trying to get anything from you. It don't know anything about you. You're the only person that will inject these fears. You inject this sense of the market is against you. Somebody called it a bad trade. Why did it lead you so wrong? These are fallacies that built up your subconscious mind that will obscure your objectivity. Will obscure your objectivity. Understand that there's no right or wrong when you're trading. There's just an opportunity to take a position, but there is no right or wrong. So remain objective, meaning that I didn't make a bad trade. I took a trade and I suffered a loss. I took a trade the market wasn't ready to produce. I took a trade the market wasn't ready to go up and down, and I got out the trade because that is acting in my best interest. I protected my bottom line. Now, you have to always make sure that you recognize that this is what the market is telling me. This is what I do. So what is it telling you right now? Then what you should do with that information. That's your charge. What is the market telling you right now? And what should you do with that information? Do you take the trade? Do you not take the trade? If you're in the trade, do you get out the trade? If you're in the trade, do you let the trade continue to run? These are the things that's so important for you to remain objective when you're looking at any trade at any given time. The sixth thing would be is that you can observe the market from the perspective as if you were not in the position, even when you are. Meaning that you don't have the pressure on you. Literally look at the market, says I'm in already. I've already accepted the risk, and therefore I can sit back with no stress, no worry. I know that I'm covered if the market does not go in my favor. And I know that I have a profit to take profit of the market when the market makes it available to me. Your job as a trader is to make sure that you're not sitting there with your finger on the trigger, holding the buttons down, just doing things, just anxious, because that anxiousness clouds your vision. It clouds your thought process. It literally sabotages your trades. So these are the things that an objective person will do when they're looking at the trades. This keep you steady. My thing to keep me flat is 50-50. The market's going to do what the market's going to do. Whether it's going to go up or down, I don't know. I can perceive or I can have a bias where the market's going to go, but I can't let that get in the way of my decision making because it will cause me trouble. Now, big thing here. An objective person is not focused on money. This is why I only talk about points in a trade. I never look at my P&L in the trade. Now, we can look at it. There's nothing wrong with it, but I'm focused on the execution of the trade. I'm focused on the take profit of the trade, and I'm covered with my risk on the trade. I never focus on how much money I can make or how much money I lost. Now, I do check my P&L because once I hit my drawdown limit, I have to stop trading for that day. If you develop these qualities when you trade, guys, objectivity is going to be your best friend. You're going to be able to do things that you never could do before. You're going to be able to have the things that you could never have before because objectivity is your friend. What does that mean, Coach? I'm going to be neutral at all costs. I'm going to be neutral at all costs. Here it is for you guys. I'm going to give you a challenge today. For 20 days, I want you to attempt to be green for 20 days. I want you to set a target for your trading. Now, if you're trading in a prop firm, you may have 10 different accounts. Okay, maybe a little different for you. If you're trading your personal, you probably have one account. But use one of the accounts for this 20-day challenge. If you're in a prop firm, if you're trading your personal account, this is a challenge for you. And I want you to restrain yourself. I want to put restrictions on you. No matter what the market make available for you, I want you to set you a goal for 20 days straight, starting today, to make $250 per day for 20 days straight. That's your goal. That's pretty easy in this market today. $250 per day for 20 days straight. I want you to set a maximum loss limit for that day. Maybe a 1-to-1 ratio. Most I can lose in that day is $250. Most I can make in a day is $250. And this puts constraints on your trading. But what I want you to do over the 20 days is develop a discipline, a cold-blooded mindset to stick to your rules, to stick to your goals, whether it be your maximum profit or your maximum drawdown for the day. It's not about the money, guys. It's about the restraint. It's about the reprogramming of your subconscious mind. Some of us have faulty thinking stored in our subconscious, and we have to replace that with good habits, to take the bad habits and replace them with good habits. What's a good habit? Being a disciplined trader. What's the good habit? Is making sure you stick to your daily rules. What is a good habit? Trading less and journaling, because a lot of us don't journal because we trade too many times a day. But what if you were only taking 1 or 2 trades a day? Would you have time to journal? Absolutely you would. So my goal is to help you to get to the place where you would journal your trades. You would trade the maximum amount of trades a day. And the rule here is the core of DTC coaching is maximum 5 trades. Hit your goal, you stop trading. Hit your drawdown for the day, maximum drawdown for the day, you stop trading. 3 consecutive losses for the day, you stop trading. Only trade the top and bottom of the hour. That's the 5 pillars of DTC coaching. I only take trades on the top and bottom of the hour, and I use these rules to guide me and protect me. Now, let's just say you're trading and you're not on the challenge, and you've traded 5 times, but you've hit your goal and the market's still running. Can you take another trade? Sure, you can take another trade. The rules are there to help you stop hemorrhaging money, because sometimes we'll hit and drop thousands of dollars a day, and it's never our intention, but we can't see it because we don't have any rules set in place, no discipline set in place. So it's 20-day challenge to help you to develop that discipline. It's not about you making money. It's about you seeing the market run for 100, 200 points, and you not trading. You just sitting there watching, or you have left for the day, and you're going to be okay with it. I want to change the way you feel about the market when it comes to winning and losing. I want you to understand what it feels to have 20 days straight of trading, 1 week of good trading, 1 month of good trading. That will change everything in you guys. So I want you to be like a trading pro. So if you do this for 20 straight days, I believe it's going to change you forever, because it takes 21 days to create a new habit, what psychologists tell us. So I want you to create new habits, this winning attitude for everything you do. Here is a chart here. Take a screenshot here. I think it's very important. And if you want to take a screenshot of the last one, I'm going to put it back up. Take a screenshot of this one also, this right here also. I think this will help you tremendously. I'll put it back so you can take a screenshot. Okay, hopefully you got it now. Then we're going to go here to take a screenshot of this one also. This is the hierarchy of a professional trader, not a professional, a person that's in the profession of trading that's getting better. The pro trader thinks like this here. Has patience, meaning that I'm going to wait for the setup. Emotions will not be tied to my trade. No fear, no me being greedy, not trying to make $1 million. I'm just going to take what the market will give me. I'm not emotional at all. And psychologically, I'm sound because I'm not in a bias. I'm not being pushed and pulled by my needs and my wants. And you should never be trading, guys, and trading with things that you have. Meaning that if you're trading, then that money that you put in the market, if it goes up and never comes back, you should be okay. But never trade with your rent money, your mortgage, your car note, your important things in the sensitive life. Never, your trading comes with excess money. Okay? But you're going to be disciplined. You're going to remain emotionlessly acting in your trades, and you're going to be patient. See, the pro trader has discipline. They wait for the best trading setup. That means their setup, it's the only thing they're going to trade. They have no emotional FOMO trading, no revenge trading. They develop a cold mindset. They only execute when the market makes it available for them. And they have correct expectations about the market. The risk management is the second most important thing, meaning that I'm going to define my risk wherever I take the trade. I'm going to be okay, meaning that I am not going to risk all of my capital for any one trade. I'm going to protect my capital because you are a risk manager. I'm going to make sure my position size is correct. I'm not going to be over trading with 20 contracts, and I know I only have the mental capital for my account size. I have physical capital for 2 or 3 contracts. That is over expectations. It's no good for you. But make sure you keep everything in discipline. This is the area where you say the most important, the next important, and the least important. Stop placements are in place for your trades. Profit assessments are in place for your trades, so you know when you're going to get in, where you're going to take profit, and that's your trading plan. Technical analysis is the last thing to be worried about. How much you know about the market. That you don't need that to know how to make money, especially if you're trading with our DTC custom trading system. You know when to get in. You know the things that you need to see. You know where prices are going to go. You know where to protect yourself at. You know entries and exits. You have everything you need to be available for you. So I want you to start thinking like a pro and acting like a pro, because you are a pro trader. I believe you can have anything you want in this market. It's an endless supply of money. And all you need to do is act in restraints. You got to stay objective. Hopefully this helped you guys out. If you got one thing out there said teaching, you've done well. Hopefully this helps you out. Remember, if you want to know more about the coaching that we do here at Dominant Trader Coaching, go to dominantcoaching.com and you will find the information there. I believe you guys can do it. I believe in you. I know you can make it work. I am Coach Kelvin, and I approve this message. At this point here, we will move forward for questions.